All right. My name is Chris Campbell. I'm a practicing CPA and I work with small to mid-sized businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today my tidbit is more so for those that are in the startup world, my startup founders. So I had an interesting situation where I had a client who had come to me not too long ago, and they were a part of a startup, or one of the original members of the startup. I'm not sure if they were the actual founder or not, but they were one of the original members there and were part of the founding team. So, long story short, during their time there, they had accumulated a good amount of shares in this particular startup. Uh, and unfortunately, years down the line, the startup went bust. So the startup essentially failed, and their shares that they had accumulated, which did have value at one point, were deemed worthless, right? They went to zero, went to bust. So the dilemma here was, look, I had all these shares and I took this heavy loss, and they just had some questions about what the tax implications are of that, because some of it was acquired through stock option shares, things of that nature for compensation. The startup game, right? You put some work in, you don't necessarily get your market value for salary, but instead you get shares. And the idea is that the startup blows up and you get paid out that way. But unfortunately, it went the other way and went bust. So what are the tax implications there with that? So one interesting thing that folks can do or utilize that are in that world, in that startup space, you can take pretty large loss right away if the stock is qualified as Section 1244 stock, or otherwise known as qualified small business stock, right? And if your stock qualifies as small business stock, which a good number of startups do qualify for that. And the caveat here is startup as in you're getting in on the ground floor startup. So if you're an employee, you might be employee number 50, and they're still necessarily in startup mode, may not apply. And I'll go through what the issues are with that maybe in a second. But, usually applies for folks that, like I said, when you're an employee number maybe 1 through 10, you're getting those initial shares that were initially doled out as compensation. But if your stock does qualify for that, and let's say it does go bust, those losses, which would be, I guess, your basis in the shares would be as far as what they were valued when you received them. If you are filing as single, you are able to deduct up to $50,000 right away. Now your loss may be bigger than that, but you can deduct that right away. So it's 50,000 if you're single, and if you're filing a married joint, you can deduct up to 100,000 right away. So that deviates from what normally happens, and is very special because normally, if you have a stock, like if you were to go onto the stock market and buy Google or any other established company, and the company goes bust, those losses that you take, you can only offset that against either other capital gains that you've made on stock transactions. If your losses exceed your gains, you can only deduct up to $3,000 a year on stock losses. With your regular publicly traded companies, run-of-the-mill securities, right? So this allows you a lot more flexibility. And the idea is that it encourages working with startups, right? Because you're being innovative, you're looking to bring something to market, it's something that's new. So the tax code is rewarding you in a sense for taking that risk, right? That it doesn't work out. So if your stock does qualify for that, it definitely helps you out. You can definitely get some big boosts, big gains, as opposed to what the losses on stock, capital losses normally allows you to do. Now, there are a couple of caveats with that. One being that you do have to get the shares directly from the company. So again, this is really geared towards those that are in that are like really in the startup phase or startup grind, is that you're performing service company, and that's just a part of your compensation. So the company is giving you the shares directly. So if you were to go and obtain these shares through, let's say, a third party or on the open market, that doesn't count. So you have to get the shares directly from the company. The other thing is that the company, at the time the shares are issued to you, the company cannot be worth more than $1 million. So with all the outstanding stock that's there, it's over $1 million in the total value of the share, at least at the time that you get the shares, right? If it goes up above $1 million after you get the shares and then it crashes, then that's fine. But at least at the time that the shares were issued to you, the total value of the company can't be worth more than $1 million. And then the other thing, and by the example here, if my client really jammed them up, is that there has to be some sort of consideration for the stock. So meaning that you either purchase them, in this case directly for the company, or they were provided to you in exchange for or as part of your compensation package, right? So you put in labor and they gave you the shares. Now, a particular situation that jammed my client up was that they had borrowed money. So in this instance, the startup themselves had actually let my client the money to go ahead and buy the shares of that company. And in this instance, that would not be deemed as direct compensation, or it would not qualify as 1244 stock because there was no new capital needed. So in this particular instance, the company loaned my client essentially their own money to have them buy their own stock. So unfortunately, because of that, it does not qualify as Section 1244, and they're not able to take advantage of those large losses. So something to keep in mind with those that might be a startup mode or founder mode is that getting loans direct from the company to buy its own company stock will negate you being able to get these gains. You're actually probably better off if they just give the shares to you as compensation and then just take the tax hit. And I guess that's what you're trying to avoid, take the tax hit from obtaining the shares if it was compensation, because once it's compensation, then you have to pay taxes on the value of the shares at the time. So if there's a little bit of value there, you can take a little bit of a bump. But if you get the loan, and especially if you get it loaned directly from the company, then it disqualifies you as a 1244 stock. Now, if you were to go get the loan from elsewhere, so I don't want to say getting a loan at all disqualifies you. It's just that because it came from the company, it was a disqualified transaction. Now, if you were to go get that loan from a third party and do it, that's completely fine. The idea is that the loan, you just really need to be on the hook for it. So just keep that in mind. But there are some tax benefits. As I said before, the IRS does reward you for going out and looking to take the risk here. So keep that in mind. If you're in a situation and it goes bust, and your shares become worthless, you do have some tax relief available to you. Now, if your losses are larger than those limits, the $50,000 and $100,000, so let's say you had a loss of $150,000, you filed as married, so you can take the $100,000. However, the extra 50 does get treated as capital gains treatment. So that remaining 50, or the excess of your limits, that gets subject to the losses, the limits that I had told you about before, as far as being able to offset against other capital gains, and then the whole $3,000 limit against your regular active income. So anything over the excess does get subject to the regular cap gains treatment. So there is a boost there. So just keep that in mind, and know that if ultimately things don't work out, there's a little bit of a benefit there. So you hope to not be in that situation, right? You don't get into business, especially with these startup companies, to see the company go bust. But as they say, high risk, high reward, right? So it is what it is. So hopefully this is helpful. And if you have any additional questions about this topic or any other tax or accounting related questions, please feel free to reach out. I'm happy to help. All right. So that's all for now. And I will talk to you on the next one.